Your portfolio isn't the only thing getting overvalued right now. In the last 5 years, 7 tech stocks added more market value than the entire economy of Japan, and your retirement account keeps climbing too. We convinced ourselves that concentration equals certainty, that buying the same 7 names as everyone else is somehow diversification. The market loved the story. The Magnificent Seven went from impressive to unstoppable. But here's the catch. Most headlines aren't about what these companies earned. They're about how much their stock prices went up, which is like saying your baseball cards are worth a fortune because one collector offered that much while ignoring that nobody else is buying. When 7 companies control 30% of the S&P 500's value, that concentration didn't appear because of divine intervention. It happened because the last person who bought paid more than before. It's like a neighborhood where every house sold for double last year's price. That doesn't mean the houses got better. It means everyone agreed to pretend they did, until they stop pretending. And we've seen this exact movie before. Same plot, same ending, different costumes, rewind. Going back to 1972 for a quick minute. America had just put a man on the moon, the economy was humming, and Wall Street discovered the perfect investment strategy: buy the best companies and never sell. They called them the Nifty 50. To name a few like Xerox, Polaroid, IBM, Coca-Cola, Disney, McDonald's, Kodak, the bluest of blue chips. These weren't speculative bets. These were America's finest corporations, profitable, dominant, reliable. One-decision stocks. Buy them once, hold forever, retire rich. Institutional investors, pension funds, mutual funds, insurance companies managing your parents' money, piled in. If everyone's buying the same 50 stocks, it must be safe, right? Wrong. By 1972, these 50 stocks traded at an average PE ratio of 42. Some hit 90. For context, the broader market averaged a PE of 19. These safe stocks were trading at more than double the market's valuation. Did anyone care? Of course not. This time was different. These were quality companies, American institutions. They'd keep growing forever, except they didn't. Between 1973 and 1974, the Nifty 50 collapsed. On average, they lost 55% of their value. Some lost 90%. Polaroid went from $143 to $14. Xerox fell from $170 to $50. Avon dropped from $140 to $18. These weren't penny stocks or crypto scams. These were the Magnificent Seven of their generation. And the people holding them, regular folks with pensions and 401ks, watched decades of expected returns evaporate in 18 months. The pattern. Here's what always happens before concentration kills portfolios. First, everyone agrees on what's safe, not through conspiracy, just through repetition. Every fund manager buys the same stocks. Every advisor recommends them. Every article lists them. Safety becomes a social agreement, not a mathematical one. Second, valuations stop mattering. Price-to-earnings ratios that would have triggered alarm bells 5 years ago become justified by growth or priced in for innovation. Expensive becomes fairly valued. Overpriced becomes expensive but worth it. Third, the concentration accelerates. As prices rise, index funds automatically buy more. As performance leads the market, active managers chase returns. Success breeds more buying, which breeds more success. It's a feedback loop disguised as validation. Fourth, skeptics get punished. Anyone who sold early, warned about valuations, or diversified away looks stupid. The market doesn't reward caution during bubbles. It humiliates it. So everyone doubles down. Fifth, the narrative becomes unquestionable. Doubt becomes heresy. Pointing out risk becomes pessimism. Asking about fundamentals becomes not understanding the new paradigm. Until something breaks. And when concentration unwinds, it doesn't unwind politely. It unwinds all at once, in whichever direction punishes the most people. So, where we are now, the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, now represent about 30% of the S&P 500's total market value. Your index fund isn't diversified across 500 companies. It's a leveraged bet on 7. These 7 stocks have an average PE ratio of around 35 to 40, depending on the month. The broader S&P 500, about 22. Sound familiar yet? In 2024, Nvidia alone added more market value than the entire energy sector. One chipmaker outweighed every oil, gas, and utility company combined. But here's the uncomfortable question nobody's asking. What did you get for that valuation? Nvidia's revenue grew, absolutely, But its stock price grew faster than its revenue, much faster, which means you're not just paying for today's earnings. You're paying for a decade of assumed future earnings that may or may not happen. Same with Tesla, same with Meta, same with most of the 7, and just like the Nifty 50, the justification is always the same. These companies are different. They're platform businesses, network effects, moats, innovation, all true, all irrelevant if you overpaid. Polaroid was innovative too. Xerox dominated its market. Kodak captured memories. Quality doesn't protect you from overpaying, it just makes the loss feel more surprising. The trap? You can't escape by doing nothing. If you're in an S&P 500 index fund, you're already overexposed. If you're in a total market fund, same problem, just slightly diluted. If you own a target date retirement fund, guess what's inside? The Magnificent 7 automatically purchased with every paycheck. The system is designed to concentrate your risk, whether you notice or not. And here's the kicker. Selling early feels worse than holding too long. If you sell now and the market keeps climbing for 2 more years, you'll feel like an idiot. Your friends will brag about returns, your advisor will question your judgment, but if you hold and it collapses, you'll lose money alongside everyone else, which somehow feels less humiliating. That's the scam. Not that the market tricks you, it's that the market makes being right feel worse than being wrong with the crowd. So most people stay, and the concentration grows. And when it unwinds, the shock isn't that it happened. It's that everyone saw it coming and stayed anyway. So what do you actually do? First, check your portfolio concentration. Right now, open your brokerage account and calculate what percentage sits in the Magnificent 7, directly or through index funds. If it's more than 20%, you're over-concentrated. If it's more than 30%, you're gambling. Second, rebalance manually. Yes, it feels wrong to sell winners. Do it anyway. Take profits from the Magnificent 7 and redistribute into underweighted sectors: healthcare, industrials, financials, international markets, small caps. These sectors have lagged for years, which means they're statistically cheaper. When concentration unwinds, they typically outperform. Third, stop buying more at the top. If you're automatically investing through a 401k, consider shifting new contributions into funds that aren't S&P 500 heavy. Equal weight index funds, dividend funds, value funds, anything that doesn't automatically pile more money into the same 7 names. Fourth, build dry powder. Keep 10 to 15% of your portfolio in cash or short-term bonds. When concentration collapses, opportunity follows, but only for people who have capital available to deploy. Everyone else just watches. Fifth, ignore your friends' returns for the next 2 years. Seriously, they'll brag about Nvidia doubling again. They'll mock diversification. They'll call you overly cautious. Let them. You're not trying to maximize returns in a bubble. You're trying to survive the pop, the survivors. Let's talk about who survives concentration collapses. It's not the people who predicted the top perfectly. Timing is impossible, and early sellers miss gains. It's not the people who rode it all the way down out of stubbornness or ideology. It's the people who recognized risk, took partial action, and positioned themselves to benefit from the reset. After the Nifty 50 collapsed, the investors who survived weren't the ones who went to cash in 1971. They missed the final run-up and re-entered too early. They were the ones who reduced exposure in 1973, held diversified positions, and had cash ready when Xerox hit $50 and IBM looked mortal. Same with the dot-com crash, same with 2008, same with every concentration bubble. The winners aren't prophets, they're pragmatists who manage risk instead of predicting outcomes. You don't need to call the exact top. You just need to recognize when your portfolio is making a bet you didn't consciously agree to make. And right now, if you own index funds, you're betting that 7 companies will justify their combined $15 trillion valuation. Maybe they will. But that's not diversification. That's faith. The stock market isn't scamming you with fraud or manipulation. It's scamming you with permission. It convinced you that buying what everyone else buys is safe. And the genius of it? You opted in voluntarily. Nobody forced you to overweight tech. Nobody tricked you into ignoring valuations. The system just made the default option: buy the index, hold forever, the riskiest bet at the worst time. 50 years ago, it was the Nifty 50. Today, it's the Magnificent 7. Different names, same math, same ending. The only question is whether you'll recognize it before or after the collapse. So if everyone around you thinks you're paranoid for diversifying, that's usually confirmation you're early, not wrong. As usual, stick to the facts. Subscribe if you find this valuable. See you in the next one.